everybody, this is Jason Ostrowski, and welcome to another edition of the Everything Real Estate Podcast. Labor Day is just around the corner, the kids are going back to school, and the unofficial start to fall is almost here, which means we are heading into the home stretch of 2024 already, if you can believe it. The pivot has also begun to our new way of doing business per the NAR Settlement, but those changes aren't limited to just real estate agents. The lending industry is going through some changes of their own. And that's why we're bringing back our friend Mark Anselmo, Divisional Sales Leader at Prosperity Home Mortgage, to walk us through some of the changes lending institutions are facing as a result of the NAR Settlement and how it can affect your business as a real estate agent. We'll also touch upon the latest good news regarding interest rates and discuss some of the new and exciting incentives Prosperity Home Mortgage can offer to your buyers that can help your clients nab their dream home. So let's fall into today's episode with Mark Anselmo, and we'll pick it up on the other side. My guest today is Prosperity Home Mortgage Divisional Sales Leader, Mark Anselmo. Mark, good to have you back on the podcast. It's been a little while, so how is life in lending paradise these days?
Thank you, Jason. Great to be back. It's probably been a little over a year since we were together here on the podcast, but all is well. There's a lot going on. I know we're going to talk about in terms of buyer agency, interest rates starting to creep down, summer market coming to a close. So keeping busy, which is a good thing, and a lot going on. So I'm sure the same for you as well.
Well, I know that you have a lot on your plate these days, and we're just a couple days into the changes affecting our industry, and I have yet to spontaneously combust. So far, so good for me, but we'll see what today brings. I've also been sick all week, and I feel like it's like the NAR settlement flu or something that I have right now.
Bad timing, my friend. Bad timing.
I know. Talk about it. So we cover things from an agent perspective to start off. We cover things from an agent perspective most of the time on this podcast, but I'm curious to know what it's like out there for a lending industry right now with all these changes taking place. Just like we have changes, you have changes. So are you having as much fun as we are right now in your side of the real estate industry?
Yes, I am sure all the agents listening can relate, but it's very similar. Now, it's not as obviously involved as sitting down with the buyer, talking about buyer agency and having them sign that contract. But what's of course changing is different loan products. And I know we're going to talk about that and what they allow and what they don't allow in terms of the buyer agent fee or commission. And then a lot of numbers to run, right? Because who's paying for it? Is the seller paying for it? Is the buyer paying for it? Is it a combination? Is it in the form of an assist? Is it out of pocket? So there's all these different, as if it wasn't confusing enough for a consumer prior to this and figuring out all the numbers and closing costs and payments, there's now another layer, right? So if we were doing a couple different estimates for a client, we're kind of magnifying that 2 and 3 times, just making sure they have all their options. They know exactly how much cash they need. They know exactly what's happening to the payment. So certainly a lot more back and forth with our clients, much like I'm sure you're experiencing as well.
I was talking to a client yesterday. I went to check out a listing that I'll be getting in a couple weeks, and we were talking about, the settlement. He's asking me questions about what's changed. And I said, listen, instead of going nicely from point A to point B, now we're going from point A to D, back to B to C, and we get to the same place eventually. It's just a much more complicated process. So it seems right now, but we'll get it all down. And so you had spoken about some of the changes to your guidelines and what you were experiencing and what lenders are experiencing out there with the NAR settlement. So I want to remind our agents of some of those rules, if it's okay, because I think sometimes we get kind of lost in the process because there's a lot to remember right now. So I think it's critically important for our agents to understand how things are going to work with lenders. And so let's start with seller concessions. What has changed for the lenders regarding seller concession allowances, limits, and how that differs with the new rules comparatively speaking to what has been in the past?
Yeah, great question. So, historically, before these changes, each loan product program has an allowance of seller concessions that obviously you got your mortgage cost, your title cost, your escrows, whatever you want to say that they're towards. There's limits. So, for example, we have conventional financing. Depending on the amount of the down payment, it's either a 3% allowance or a 6% allowance. FHA, VA, those range from 4% to 6%, 6% for FHA. So those were always like the parameters that we would work under, right? Hey, we have X percentage for all these closing costs. You can ask the seller, as part of your offer. In comes buyer agency. I mean, the good news is all the agencies followed suit pretty quickly when this was announced a few months ago. So Fannie Mae, Freddie Mac, which is your conventional financing, basically said, hey, we will allow the buyer agent commission cost to be above and beyond our limits, right? So if they're at a 3% limit on a particular transaction, you can use that 3% for your title fees, your mortgage fees, so on and so forth, like you always had in the past. And now there's an allowance to go above and beyond that specifically for your buyer agency cost. So after Fannie and Freddie said, we're going to do that, FHA then said, yes, we will allow that as well. VA most recently said, yes, we will allow that as well. So the good news is everybody has, all the larger agencies have pretty much followed suit saying, listen, if this is, if it's above and beyond for this particular cost, we will do it. Now it has to be specific on the agreement, that shows, hey, look, these are the general closing costs. This is the buyer agency cost, and kind of have it outlined that way. So when that loan goes into underwriting, it's seen that extra concession that's being asked is going specifically toward the buyer agency fee. I don't want to say outliers, but the only things to double check on would be with just like credit unions, banks, jumbo investors that might not follow Fannie Mae, Freddie Mac, FHA, VA guidelines, that have maybe their own nuanced guidelines. We have noticed a lot of the jumbo lenders are following suit, with Fannie Mae, Freddie Mac, which is good to try to keep it as uniform as possible. But there could certainly be some outliers there. So those would be the only, when you have your nuanced products and your nuanced investors and small, we use a few small credit unions and banks, and we're just making sure we're all on the same page there, because they could technically have their own overlays, and own guidelines there. But generally speaking, Jason, the nice thing is it's fairly uniform across the industry, where we can go above and beyond to cover that cost if that's what the transaction has negotiated.
My follow-up question was going to be things like state loans, like a PHFA, right? Or something like that, even like USDA. I know we don't see a lot of those these days, but you're telling me that basically everybody has kind of jumped on board with this, outside of some outliers, some kind of exotic loans out there that may still have the similar, or maybe the same guidelines that won't allow for, a buyer concession. Is that fair to say?
Yeah, that's accurate. So, for example, a lot of the bond programs, they're backed by Fannie Mae, Freddie Mac, FHA anyway, right? So those kind of fall within the same guidelines. So yeah, outside of a few outliers, again, I think that it's kind of that smaller credit union bank type niches. You're going to be in pretty good shape with assuming that you're going to be allowed to go above and beyond those limits for the buyer agency cost.
So are you hearing anything anecdotally? Now, I know it's only been a couple days, but new agreements are going to start rolling into lenders. Are you seeing anything out there that has that concession to it? Or are you seeing business as usual for the time being, and maybe we need to catch up as we go along here, we're going to start seeing more concessions? Are you seeing like business as usual, or are you seeing some subtle changes to the way that agreements are rolling into lenders right now?
Yeah, it's mainly, it's obviously super early. We're in this a few days. In talking with a few of our sales folks, we've seen a few, right, that have that above and beyond, the normal concession limits. And again, the contracts are structured properly where, it's on a separate line item for the buyer agency fee. But generally speaking, and curious what you're seeing as well on your end. It has been mainly business as usual, where we haven't seen too many of those come through. I'd say maybe about 10 to 15% have been above that allowance. Again, we're just a few days into this thing, but my general thought would be the majority of transactions will probably not have that extra, allowance of closing costs that, we've been talking about for the last few minutes. But certainly there's going to be a minority that do, and it's going to be necessary to get these buyers to the table.
I think it's going to be very interesting to see how these new rules are used based on the market that we're in. Because if it's more of a buyer's market, then, traditionally you may see a buyer asking a seller for a concession anyway. And the more leverage that a buyer has, then they may use that as an advantage to when they formulate their offers to ask the seller for XYZ, including potentially a buyer agent's commission. In a seller's market, you could see the seller using that to their advantage and putting the squeeze on commissions and making the buyers pay their agent. So it's going to be very interesting to see how this dynamic plays out, especially with what we're going to get into next. And that is interest rates, because that is going to be kind of our guiding light as what kind of market maybe we're heading into. We've been in a very strong seller's market for, a long time now. And I don't necessarily see that stopping with what's on the horizon. So we had economist Dr. Lisa Sturdivant on the podcast last week touching upon the interest rates and what she thinks will happen in the foreseeable future with the Fed cutting rates heading into the fall. So I want to get your take on where we currently stand interest rate wise and what you think is going to happen in the near to, I don't want to say long term, but heading into 2025.
Yeah. So a lot going on with interest rates right now, and it's been positive over the last couple of months, which has been great. And take into consideration all the changes in buyer agency. And if you think about it from a buyer perspective, if they are financing, right, or asking the seller to pay for the buyer agency commissions, what is that doing? Of course, that's increasing the financing amount. That is then increasing their payment, right? So in the face of rising interest rates, which we've seen for almost 2 years now, up until about a month and a half, 2 months ago, just another headwind for us, right? But the nice part now is as rates are now trickling down, it's going to make those conversations about payment a little bit easier with our buyers, especially if they're looking to not just finance regular closing costs, but again, finance the buyer agency costs. So what we're seeing, Jason, I'll use a 30-year fix as an example. With no points, right? Just to kind of keep it uniform. We topped out as high as about 7 3/4, about 7.75%. That was at our high. We kind of touched on that late last year. Things trickled down a little bit and then popped back up in this late winter, early spring, back into the mid sevens, right? So there was about a mid to high sevens in front of a 30-year fix with no points for quite some time. For those of you that kind of track the markets, inflation, of course, is like the key piece here. The Fed has been raising interest rates for about 18 months to slow inflation down. Inflation topped out, I think, somewhere at 9% at some point. The target range is 2%, that the Fed says, hey, look, we want inflation around 2%. And actually, it peaked below 3%. So if you think about going from 9 to below 3, those interest rate increases that have been happening over the last 18 months, finally started cooling inflation enough to where the general consensus now is the Fed is going to start cutting interest rates, and they're going to do it. It's basically already baked in. It's 100% chance that they're going to cut rates in September. Now, the question is how much and how aggressively. So for example, the market has already baked in a 0.25% decrease that they'll decide upon in September. There's about a 50% chance they might cut it by 0.5%, right? So the question is like, how aggressive are they going to be? And then how long are they going to cut? One thing like to understand as well is the markets and the rates already bake in what's anticipated by the Fed, right? So rates have actually come down considerably over the last 45 days. So that 7.5, 7.75 that was at a high, I mean, now we're trending in the mid high sixes. So rates have already come down about a full percentage point based off the fact that when these readings come in on inflation, there's been some lackluster jobs reports that have come in, and those actually help interest rates. Weird bad news kind of helps rates. So as those reports have come in over the last 45 days, rates have started coming down. So when the Fed actually announces in September, hey, we're cutting by a quarter or a half, you might not see a knee-jerk reaction. The key is always, what are they planning for the future? Because they'll also kind of give hints towards the next meeting, and what the anticipation is there. So that's kind of some background. I mean, to answer your question about kind of what we are seeing, we are predicting 3 to 4.25% cuts by the end of the year, right? So there's a couple more Fed meetings left. So between 75 and 100 basis points is certainly within the realm of possibility. We do anticipate that they'll probably cut a little bit more into the first quarter, right? So what does that mean for us in our world and fixed interest rates? Again, right now we've kind of trended from mid sevens to mid sixes. There is a legitimate chance we can peak into the fives, right? On a 30-year fix, I'm talking again, 30-year fix, no points, just like they're not buying down, the client's not buying down the interest rate. And I think if we can get into the fives by, first, second quarter of next year and into the spring market, I think we'll all be very busy, my friend, because that's going to certainly, you think about somebody's payment from a 7.5 rate to a 5.75% rate. And again, to tie this all together, kind of makes that buyer agency cost, right? If the buyer's having to finance an extra few $1,000s into their payment, really not a big deal. That's maybe $15 or $20 a month compared to the few $100s a month less their payment is from 7.5 to say 5.75. So good news on the rate front, and especially again in light of these changes and all these extra conversations around cost and payment we have to have. Certainly good timing for all of us. So that's what we're seeing and forecasting over the next, I'd say, 6 to 9 months. Anything past that, it's pretty hard to forecast. So much can change and evolve, and we've got an election coming up, and we've got reports that come out every month that could change things a little bit. So tough to forecast beyond that, but in the near future here, I think we have some good news for our buyers and all of us in the business.
It's music to all of our ears, I'm sure, if we can touch into the fives, because I really do think psychologically, we just see that 5, then I think I know buyers are going to be out there, but what I want to see is sellers be willing to move that locked interest rate. And I think that the general public knows we are not going back to like a 3% interest rate anytime soon. So if at all, in the next, God knows, however many decades. So I think they can live with the 5s. They can say, hey, you know what? I'm willing to move on. I'm willing to accept that rates are in the 5s now. I really want that dream house, and I'm going to list my current home. And I think that's really going to release that bottleneck of inventory that we desperately need out there for buyers. And that would just be such a godsend heading into 2025.
Yeah, I couldn't agree more. Like, to your point, yes, 3%, and let's just talk maybe the next couple of years, right? 3%, probably not realistic. And again, that 7.75 we saw, now we can probably say probably not realistic to get back there either, right? Which is because for a while there, we're like, when does this stop? We went from 3 to 4 to 5 to 6 to 7 to 7, like all over a 2-year period, right? It was the largest increase in interest rate that we'd seen since I think like 1981. So now we can probably safely assume the worst is over. And to your point, we get in, peek into the 5s. That seller who has 3.5 can justify moving to 5.5 and listing their home to go buy that new house. And then, of course, I don't know how you feel, but of course, there's the inventory shortage there for a while, and all the buyers that had to move bought. But then we saw a lot of buyers sit on the sidelines and say, I can't pay this payment for 7.5%. And so buyers are going to, that segment of buyers is going to come back into the market. We could have this really nice conglomeration of those buyers coming back in and sellers saying, you know what, I will list my home because rates have come back down enough to where I can make it work. So
I'm already excited for next year, man. I'm telling you.
Me too.
I think it's going to be a great year for all of us, and quarter number 4 for that matter. I think we're definitely going to see sales increase here as we get to the end of the year, which is kind of, I guess, out of the norm. But we've been out of the norm for for basically
too long,
4 years now. I mean, who's counting at this point? So,
That's right.
I also want, since you're here representing Prosperity. I wanted to touch upon some of the great incentives that Prosperity offers currently. And I know we talked about this off camera a little bit. I want to touch upon that. The Home Sure Advantage is a new one, great program. And so I want to make sure that our agents know about it in order to use it in these competitive situations that we're in right now. So can you talk a little bit about any new programs that Prosperity has, or anything else you want to touch upon, and how Prosperity can help the agents at Fox and Roach?
Yeah, totally appreciate that question. So there's a couple things, and I guess to start, look, we understand it's more important. It's always been this way, but more important now than ever for you as an agent to show your value to a buyer. And that's always been the case, but now you're sitting down, you're saying, we've negotiated this price to pay. Showing your value is even more important. And so we have, you mentioned the Home Sure Advantage. So that's encompassed into what we call our Competitive Edge program. So I did want to take just a minute to explain that, because I really think it gives an agent another bullet with that buyer to say, listen, my in-house lender here at Fox and Roach offers this. And so what it is, Competitive Edge, there's 3 components to it. One you touched on, which is the Home Sure Advantage. And some of you may have heard this. We sunsetted a prior program called Buyer Advantage, and we kind of put it on steroids, which is what Competitive Edge is. So the Home Sure Advantage is that upfront mortgage commitment, right? So an agent sits down with a buyer to sign buyer agency. Our mortgage consultant can certainly do a general pre-qualification right then and there. But then we can also take that a step further and say, let's get you fully committed. That way, A, you don't have to do it later, but B, when you present an offer to the seller, you have a full-blown mortgage commitment. So it's basically as close to cash as you can get without cash, right? You're basically, hey, look, I'm already fully approved. This is not a flimsy pre-qualification letter from, an internet lender. This is a full-blown commitment. So that's component number 1. Component number 2 is what I think is the most compelling when it talks about, again, showing value an agent to a buyer. We have a $30,000 closing guarantee when associated with the transaction when we do that upfront mortgage commitment. So where does that $30,000 go, and what does that mean? So basically, if we don't close that loan due to our own fault, right? So it's not a home inspection issue, it's not a buyer and seller issue, it's a mortgage issue, right? If we issue that Home Sure commitment upfront and then can't close on time, $30,000 gets paid out from Prosperity. $15,000 goes to the seller themselves, and $15,000 goes to the listing brokerage, right? So, Jason, if you're co-oping with an agent from Keller Williams, right, that Keller Williams branch would essentially get that $15,000, which of course would trickle down, to the agent themselves, right? So, what's the purpose of that? If you think about it, Jason, you have your buyer, you present an offer to that Keller Williams agent, and basically you have this closing guarantee with a full-blown commitment, right? And basically you're telling that Keller Williams agent, hey, you're going to make $15,000 to your branch at Keller Williams, and that your seller is going to be paid $15,000 if Prosperity doesn't pull through on this commitment that they just issued. So talk about putting that buyer in a completely different light especially in multiple offer situations. But even if it's a single offer, just to have those extra assurances attached to it probably helps a little bit of the negotiation of the price, puts the seller and the seller's agent at complete ease. And so kind of circle back to what value is Prosperity trying to help our Fox Roach agents with as Fox Roach agents are showing their value to buyers at the time of that buyer agency agreement. Talk about an extra tool to have and say, listen, use Prosperity, use our in-house lender. I'm partnered with them. I work with them all the time. And you can be insured that really have your offer stand out with this competitive edge program that Prosperity has. The last component to it really isn't too relevant. It's called refine your rate, which means when the buyer settles and let's just say rates keep trending down, we're gonna refinance them and we're gonna waive all of our fees on the refinance. So there's a little extra carrot there for a buyer. So that's our competitive edge program in a nutshell. Which again, I think really, I think our Fox Roach agents should embrace that and put that into their value proposition, I think, to a buyer. And then the second component is just like an upfront partnership that, we've always had historically with our Fox Roach agents. But again, I think in light of these changes, certain things are magnified, right? Like we've seen some agents wanting to bring their buyers into the office, meet face-to-face, meet with my mortgage consultant, who, again, then the mortgage consultant can go over these different programs, meet with Trident Land in the office, meet my broker manager, kind of create that team atmosphere in a professional setting. Again, another value add. We've always cross-selled, so Jason, you refer a buyer to me and, you talk about Prosperity and maybe me as a good mortgage consultant, right? I've always historically been like, Jason's great, right? Jason is a fantastic agent. Kind of doing that a little bit more boldly and upfront. Like we want to cross-sell each other here and partner with each other because buyer hasn't signed buyer agency yet, right? We want to help sell your value and talk about all the things that you bring to the table as an agent. And then lastly, we touched on it earlier, it's the running of scenarios. I mean, it's more important now than ever. I think, if I kind of had a message to the agents, if you're using an internet-based lender, a credit union, a small bank that is 9 to 5, that you're not going to be able to call on a weekend or a night to run. Again, the numbers have gotten more complicated now, and there's more scenarios to run. There's more options. There's more negotiating that'll be taking place back and forth around buyer agent fee. We are running more and more scenarios per client. And that's that's our job, and we love doing it, and we're always available. And I think that that's always, again, all these things have always been important pre, August 17th, but all these things magnify now, and our partnership together between Fox and Roach and Prosperity and of course title and insurance, and having that package to be able to sell to a buyer, I think becomes even more important. So that's what we're working on, and we're doing every single day to hopefully show more value to our agents, who can then extend that value over to their buyers.
Well, I think two things right away with competitive edge. That number one, it gives a seller surety. And I always explain to my buyers, we want to give as much surety to a seller as we possibly can if we're in a competitive situation. So how can we do that, right? How can we frame this offer a certain way to mitigate any chances that we're going to go through the process, we're going to get to the finish line, right? So having the buyer have that advantage that they're already pre-approved, they're already basically, through underwriting for the most part, that they are going to be there at the finish line, number one, is important for a seller. But number two, obviously, working with your lender in-house that, like you said, if there's ever a problem, again, I want to provide surety to a seller. I always say, if you want to contact my lender that I've been working with for years, that I trust, feel free to reach out to him. He's always available. And the other thing that I think that's great about this program is that you want to stand out from the competition too. And if everybody else just has pre-quals out there and you have a pre-approval already, you can make that case even stronger. This is my lender. We're already pre-approved. We're good to go, right? We can close really quickly. I think that's another aspect of this, that, you have them lined up already. You can have a quicker close. So would you agree with that, Mark?
1,000%. I'd say too, it's funny in the industry, like generally speaking, right? Like lenders are all fairly uniform, right? Like we all get our rates kind of from the same places for the most part. The programs through Fannie Mae, Freddie Mac, FHA, Bond, like pretty much all lenders kind of have those things for the most part. And yes, we try to pretty them up and make them our own and try to, sell that way. Very rarely is something like truly, there's really nothing out there like it. And quite honestly, like I have seen a couple lenders that try to do the upfront commitment, but I haven't seen that coupled with the closing guarantee, right? The $30,000 closing guarantee. Like it is truly something that if it's out there, I'm not aware of it. And if it's out there, not many other people are doing it. And again, I think that that's kind of the special part of this as it pertains to, again, an agent trying to show their value to a buyer. I mean, this is something like that really isn't heard of. Like what mortgage company is going to say, I have $30,000, I'm going to back this approval with. So it certainly separates, separates that agent to that buyer, because this program is a pretty exclusive program that I just haven't seen out in the marketplace. So something to definitely sell.
Yeah, it's pretty robust. I actually don't really like that word robust. I don't know where I'm getting that from, but it definitely is a good program. And it's eye popping, right? When you see $30,000, you're like, wow, that is not like a small amount of money. So I wanted to ask you, so I'm kind of veering into the future here, right? So at some point in the near future, and I know this is not on you, and I know this is not on lenders, but will buyers be able to DocuSign all their mortgage paperwork at some point in time? Like, can we have like 5-minute settlements in the future, like almost like a drive-through settlement?
Man, I didn't expect that question. That's a good one. I actually do think so. I really, and there's some lenders that are a little bit, so of course there's a partnership with the title company and all. Yeah, there's some lenders that kind of have it like 3/4 down. We actually all have a hybrid package as well. Yes. Where a borrower will sign some of the documents prior to via DocuSign, and then at the table they are signing maybe about 60% of them, right? So it shortens the closing. Not quite the drive-through that you're talking about. I do think eventually, and it's probably not that far off in the future, quite honestly, it's probably 1 to 2 years away where that's probably more of the norm, which has its pros and cons, right? Like, the beauty of settlement is kind of like, the celebration of it and the networking that happens and all those things. But yeah, certainly have to evolve with the times too. And it's, those settlements have been getting shorter and shorter. It used to be an hour is probably more like a half an hour on average. But 5 minutes is probably coming, Jason. And it sounds like you're on board with it. But yeah, it's a little bit more involved in the back end with, like for example, like the signing of the mortgage and the note and the deed and all those things that kind of have to be backed into like Fannie Mae, Freddie Mac, and kind of getting involved in at those levels. But it is slanting more in that direction, and I think your 5-minute settlement, let's say 2027.
All right, I'll take
maybe 26.
I'm writing that down, Mark. You're definitely on the hook for that if that doesn't happen. No, I'm totally joking. I do love the hybrid closings now. I think my title people are like sick of me because I can't shut my mouth during settlement. They can never get through their paperwork. So
you're the guy who makes the settlement still take an hour, right?
Yeah, I was going to say it will still take an hour for my client just from my being there. So I need to really just like button up a little bit is the bottom line. So last question to you. So I always end with an offbeat question. So my very last question to you: are all underwriters sadists, or are they just bad people?
I think they're all just bad people.
And listen, I love you underwriters out there. Okay, I'm just gonna tell you this is
a thankless job, man. That's a thankless job, because it's like it's funny because the reason why underwriters are so tough, right, is because of course all their files get audited after closing, right? And all if an investor comes back to us and says, "Hey, Mr. Underwriter missed this," Mr. Underwriter hears from his boss, right? So it's like this fine line of like, how crazy do I need to drive these people and like create all this turmoil in the transaction with, I like my job and I don't want to have too many like defective files. So it is a thankless job, but let's just call them bad people. It's easier that way.
I definitely now I'm gonna not get my loan approved, and I'm definitely gonna have to do some weird stuff I've never done before because underwriters
We
listen.
won't show them this podcast, Jason.
I did come across. I do actually have a question for you. Do you see more requirements, not necessarily from underwriters, but maybe it's an appraiser going out to a property? I had an issue recently where it was a conventional loan, wasn't like an FHA loan with FHA guidelines, and they required, a railing to be put in. And I had never come across that with a conventional before. And the appraiser called it out and said, "Hey, this needs to be done." Are you seeing more of that? Do you feel like, or is that just kind of a weird anomaly? I've heard a couple people say that recently.
Yeah, it's interesting. I mean, I honestly haven't really. If anything, I feel like things are getting a little bit more streamlined. I mean, obviously with technology, appraisals aside, right? Like being able to pull assets and bank statements and pay through like a verification of employment online, and like generally speaking, I mean, there's some loans we do that require very very little documentation because it's all automated. I think in that situation with appraisals are probably a little bit different, right? And in that situation, an appraiser probably thought it was a safety concern, like a significant safety concern. Obviously, not having a railing is generally a safety concern, but like a lot of times conventionally, it won't flag, where FHA that would flag every time. But if it's a significant, what the appraiser feels is a significant safety concern, which you may have disagreed with on that one, they could point it out. Appraisals probably haven't changed that much, just from like, hey, are appraisals more streamlined now than they were, say, 3 years ago or 5 years ago? Probably fairly uniform. I'm probably sure you run into one from time to time. It's like, what is this appraiser thinking? You'll probably still continue to see that in the future. Now, keep in mind there are a little bit more of the accepted value through Fannie Mae, where you don't need an appraisal, or it's just a hybrid appraisal. So that has ratcheted up a little bit more over the last few years. But if you are getting a full appraisal inspection, it's pretty similar to what it was a number of years ago. Where we're seeing more of the technology help out is on the income and asset side of things to help buyers get through that process a little bit easier.
Yeah, I definitely do see more like spot appraisals, or, the computerized, like you said, hybrid or whatever, taking place, which I appreciate. I think we all appreciate that. So the more automation involved, typically the better for us. So anyway, for those of you out there that want more information on the competitive edge, Mark, where can they find that? Just any literature involved, any emails going out, etc.
Yeah, so I mean, the easiest thing to do is, of course, talk to your mortgage consultant in your office. They have all the materials. We have co-branded materials. We have marketing materials for it. So that's always your easiest resource. Of course, it's posted on all of our web pages as well. So we have it spread out pretty far and wide at this point. But your mortgage consultant in your office is always your best option.
All right, man. We'll take advantage of it out there, agents. And Mark, thanks so much for joining us. I know I'll be talking to you in the near future.
Much appreciated, Jason. Thanks for the time.
That was the conversation with Mark Anselmo. It was great to talk to Mark again. Here are a few takeaways from our time together. Number one, by now you have probably heard about seller concessions being used to potentially have the buyer pay their agent, which is different from the regular concessions that we have been used to and the limits thereof. But I thought it was important to re-emphasize and go over again with Mark what that means to you as an agent, what that means to your buyers, and to kind of pound it into our heads that we can use these concessions that go from the seller to the buyer, and the buyer will pay their agent. In the end, some things are changing, some things are not, but always make sure to check with your lender about the allowances involved, just to make sure that you're doing things correctly. Number two, we talked about this on our last podcast, but good news on the interest rate front. Interest rates are subsiding and will continue to hopefully subside heading into 2025. I think Mark touched upon that rates may be cut 3, maybe even 4 times before the end of the year. What that means for us is hopefully a busy quarter number 4 heading into 2025. Hopefully mortgage applications will be on the rise, more buyers will be in the marketplace, and more sellers will want to sell. So this is all good news moving forward here into next year. Last but not least, if you are writing an offer and if you are using Prosperity Home Mortgage, then make sure to get your buyers pre-approved, not just pre-qualified. It is a huge deal, especially in a competitive situation. And now with Competitive Edge, there is even more incentive to get them pre-approved. You have $30,000, their closing guarantee. So make sure to have that conversation with your buyers and take advantage of the program. That's it for this week's podcast. We will be back in another couple of weeks with a new topic, a new guest, and as always, if you want to hear something that we haven't covered yet, please reach out to me, jason.ostrowski@foxroach.com. And if you haven't liked and subscribed to the podcast yet or left us a review, please do so. It helps us to reach more people. Once again, this is Jason Ostrowski saying stay safe out there, stay selling, and we'll catch you on the next episode of the Everything Real Estate Podcast.